Hey guys, Doug the Retirement Guy here. Going back to our bond market review, we have a new one for you, the Capital Group US Multi-Sector ETF, better known as CGMS. This comes to you from the Capital Group. They're promoting a dividend yield of 5.9. So we want to see if this is going to be good for your retirement account, put it on your bond side. But before we get into the review, I want to personally say thank you for everyone who watched the videos, who's clicked on that subscribe button, and always giving us that thumbs up. It really helps. We are here to help you, and if you have any questions, comments, put it down below. We'd be more than happy to help support you. Getting into today's video, CGMS really is a high-level fund for current income. Its secondary is always for capital appreciation. They're normally investing 80% of their assets into U.S. markets and primarily into bonds and debt instruments. So basically buying all different kinds of grades of bonds looking for that high return. Their distribution of 5.98 is very solid. And the 30-day SEC yield 6.33. It means they're getting a lot of cash back on a short-term basis, which we see from bond funds. The other nice thing I like about this, the expenses are very low, 0.39%. So when we take a look at the breakdown of what they're investing into, the one that gets me the most is corporate bonds, notes, and loans. 71% of their funds they're basically doing this directly to corporate, buying corporate bonds and so on. The next one that they do is mortgage-backed obligations. So this is a solid, very solid bond fund and income fund. When you see mortgages backed, that means they're backed by government. The government's going to back it, so they sell it off. These guys are buying it. So very strong at that point. When we looked at their top fixed income issuers, right there, federal home loan mortgages make up 1.9, Fannie Mae 1.5. Add those two together, so you're a little over almost 3.5% of their fund is going into the mortgage that is, from federal and Fannie Mae. Next, we look at where are they breaking down, and you see 85% of this is done in the U.S. and then basically 5.7 is other, and then Europe is 5.2. So you can really see they're really based in the U.S. doing most of that U.S. market. Now, this is one that I always said, I tell everybody with bonds, normally what you're going to see is a 3 to 5 year average life expectancy. Well, because these guys are putting more and more into loans, mortgages, and so on, you see the difference in these. Average life, 46% of theirs is at 0 to 4.9, we'll say 5 years. 46.1%. 40% of theirs are that 5 to 9 year note program. So they're getting really a nice mixture of the short terms, which are very common, of that 0 to 5, and then that 5 to 9. So really, they're covering their market for a long-term distribution and income. So when we took over here, this is the next thing, is where is the money being spent at? And you look at it, 20% of their bonds that they have are A-rated. So anything, if you don't understand, but anything basically from BB all the way up to AA are what they call investment grade bonds. Okay, BB is being the very lowest. It's on that verge of being into what they call junk bonds, and above that is investment grade. And you look at their numbers; they have a 39, almost 40% in BB and A bonds. Add in another 10, so 50% is investment grade bonds. And then they pick up a little bit in that BB category, which of course we have to say those we'll classify as junk bonds, but they're on the high end, very high end of it. So very solid again. The lower you go, same old thing. The lower you go, the higher the return you're going to get. So they're getting into that meat of the return, but low risk area. So we look at this and say, why CGMS? Well, it should say why bonds in the first place. And bonds are smooth over time. So it stops that roller coaster that we've seen over the past 2 months. Stock market going up and then it drops dramatically down, the big drop off, and then starts to recover and drops again. In retirement, you want to have, I call the set it, forget it for a portion of your portfolio. And that portion always, you want that to be your fixed income of what you're planning on living off of. And that's what bonds will do for you. It takes away that up-down scenario. The safety, investing in high level rated bonds gives you that safety into retirement. So you do not have to worry about, again, that roller coaster ride, or am I going to get paid? It's pretty solid. And then the returns, 5.98% for CGMS and a 6.33 30-day, which means that you're seeing a 6% return off the value of the stock in the next 30 days. So it just means you have a regular cash flow coming in from those funds. Now, the best thing we love here on the channel is offering monthly dividend payouts, because in retirement, you want that regular cash flow so you can pay your bills. You can do everything you need to do, hitting your budgets, doing your financials, everything through onto it. So very, very solid when you're getting monthly payouts. Wow, let's take a look at this one, the return from CGMS. This fund started in October of 2022. Okay, and if you look at this, the month of April, or excuse me, this is year to date up to April, they're down negative 0.31, which is not bad when you take a look at the marketplace being down 10 to 15%. And when you take a look at the 1 year, they're at a solid 6.95%. And then when you look at the lifetime of it, they're at 9.88%. So again, solid foundation, solid programming, but we've seen a little bit of a drop off in the March and April madness. But across the board, again, like I said, it's a very solid piece. We take a look at the dividend chart. Again, the dividend chart is, you're thinking this is going to be, wow, this is a roller coaster. This is not good. The positive of this all is when you look at the average across the board is 13 cents a month. Every dot that you have is they're constantly giving you either a bump up and then back down to basic, a bump up, back up to basic, which is a great one in dividends. This won't make any of the aristocrat programs. It won't do any of that because they give out the money when they do good, and then they go back to their base, which is we call 13 cents. This fund will pay you $1.58 annually, and that's really what you want to look at. So what we do is we always take and put $10,000 into an investment to see how it does for our performance over 12 months. So we did this program for 24. So at that time it was $26.72. So we were able to buy 374 shares in the bonds. Jump down. I always like to look at this is in two ways. Before the March crash or during the March crash at 321, we were up $299, or basically we were up 3% in March. Once the April tariffs that every stock out there, every fund pretty much took a major drastic hit, this one lost a little bit, but we're still in the green. We're now, of course, 0.45 is nothing to write home about, but you are in the green when other places have dropped 10, 15, 20%. We look at the dividend return, and again, at that 13-cent average, it came in at $592 or 5.93%. It's a solid number for a bond fund. And we look at the return of 6.38. Again, this is a solid return across the board. The next thing I always look at is the price adjustments over time. The top category is 12 months, and CGMS was steady. The average price over 52 weeks is $27.36. The current cost of the video was at $26.72. It's only 0.64, which is just a touch above, 0.5% below average. So all it did was took its gains and came back down to its average point. The next one down is April. And basically what we see from this one is that CGMS held up in the March drop. The highest point it was in March was $27.40. It bottomed out at $26.37, which is a 3.7% drop when the market was dropping 10 to 16%. So again, you did not have that huge drop off, that roller coaster ride as we talk about. So the advantages that you have here at the current price of 26.72, you could pick up a 0.5% of growth just getting back to the average. And you're going to see that it's almost coming back to that point already. So very little movement, very steady across the board, which is what you want. So when we look at the past, over the past month, CGMS was down 1.75% when the S&P was down 5.27. 6 months, it was down 1.89 when S&P was down 5.97. Year to date, it's down 0.81 when year to date S&P is down 6.91. So you can see the bond fund is definitely holding better than the S&P 500. Now we give you this. It's no roller coaster ride here, guys. There is no ups and downs. You are pretty much on a standard smooth sailing across the board. That's the nice thing about bonds. Bonds are smooth sailing. You are not going to get the big double-digit returns, but you're not going to get the massive fall off of a major roller coaster drop off. The thing with bonds that happen is real simple. As the interest rates start to come down, bond rates will go up. They operate opposite from each other. That's why we're doing this series. I think it's right now time to buy bonds so that you can have your retirement package set up for the long term. So in summary, stock return over the last 12 months, 0.44. I would expect to see that increase dramatically over the next 12 months. Dividend return, 5.93, very solid. Total return of 6.37, including your dividends. Again, big thumbs up. It's when the markets were down, stocks were down, this one held its own, kept continuing moving on. So you have a nice broad appeal across the board. So is CMG good for a retirement account? And the answer is going to be definitely a big yes. Morningstar risk level is very low. The dividend at 5.93, you're not going to get, as I always say, you're not going to get majorly rich off of this, but you're not going to lose money on this at the same time. It's a smooth ride across the board. Growing over troubled times. So we put this as a moderate buy, and don't be afraid to put this one into your retirement account. And I always suggest to everybody, build a segment of bonds, build a segment of REITs, build a segment of your growth stocks, and this one fits properly right in there. Guys, this is Doug, the Retirement Guy. I hope you liked the video. If you do, give us a click, give us a thumbs up, hit the subscribe button. Don't miss any of our videos that we're putting out. We're trying to give different information in different ways that everyone else is doing. And if you like what we're doing, leave a comment. If you don't like what I'm doing, leave a comment. I like to hear the good, the bad, and the ugly. So let's go from there. Everything helps the channel grow, guys, and I appreciate it, and we'll see you next time.